Today on the show, we're going to be talking about the new 2025 Small Business Administration changes to the SBA 7A loan, one of the most popular loan products out there for people doing a small business acquisition. So, we're going to be talking about the changes and we're going to be talking about some of the ways that I think it could be affecting how deals get done and how it's going to change the landscape out there for people that want to buy a business. So, stay tuned.
I'm David C. Barnett, and you're tuned in to Small Business and Deal Making, the podcast, YouTube channel, and blog where I talk about buying, selling, financing, and managing small and medium sized businesses while controlling risk. So, if you're looking to take control of your future through buying a business one day, or if you already own a business and you're looking to grow or exit, you've come to the right place. I talk about interesting things, I talk to interesting people, and I answer your questions every week right here. So, be sure to hit like and be sure to hit subscribe, and let's get to it. Are you thinking of growing your business or beginning a journey into entrepreneurship? Take a shortcut to success by buying an existing and profitable business the right way. Visit businessbuyeradvantage.com and learn more about my online training, group coaching, and consulting services designed to help you win.
So if you haven't heard yet, if you're in the United States, there have been some changes to the SBA 7A loan program that have been brought in since the new administration has come into office. And we're going to be talking about some of those changes here today. I'm not going to go specifically through all the changes because there are a lot of them, but I'm going to be going through the sort of top line changes that are in really going to impact the way that people might put together an acquisition deal like the ones that we talk about here on this channel, or if you're just consuming stuff in the small business acquisition space broadly, a lot of the things that you've heard or maybe heard of people doing over the last few years are going to be much more difficult to pull off now that some of these changes have come in. And we're going to be talking about, what I think of those changes because it's my channel. I like to share my opinion from time to time, but I'm going to share some other people's opinions here as well about how they think that some of these changes are going to impact people. So, if you're not aware, there have been some changes, and I'm going to go through a couple of different websites here quickly that are just going to list out some of the things that have changed over the last little while. So this is a First Financial Bank, and I just found this from a internet search, looking for 2025 SBA loan changes, and so they've got a pretty tight summary here. So the first thing they put is prudent lending rules are back. So they basically tighten down some of the structures, the rules, the way that underwriting happens, and some of the sort of validation of identity and things of that nature. Tighter citizenship and ownership requirements. So the SBA is now requiring 100% ownership of a business be held by U.S. citizens, nationals, or green card holders. I guess permanent green card holders. There's a difference there. Um, and so people are saying, like, "What do you mean other people were using it?" Yeah. So there were people, for example, who would find a foreign partner to put up 49% of the equity, and then the American citizen would own 51%, and then they could use an SBA loan to add leverage to their deal. The other way that foreign people were able to use SBA financing is if a foreign person owned an American-based business, they could also use an SBA loan to acquire assets to grow that business, think of things like a truck, with the idea being that that expansion of the business in the United States could add to employment in the US. So from what I understand, that's off the table now. So it's strictly for US permanent residents and US citizens to use, which, I think kind of makes sense because the ultimately this 7A loan program does represent a certain degree of subsidy to the activity of buying businesses, and you're guaranteeing loans which are ultimately backstopped by US taxpayers. So to limit the benefits to people who are US citizens, I think kind of makes sense to a certain degree. The the whole subsidy thing, just to remind everyone, basically the way an SBA loan works is the SBA itself does not actually make loans. People apply to a bank for a loan and it gets an SBA guarantee applied to it. And because of that guarantee, banks are doing loans that they might not normally do. And the if you were going to borrow 50% of a house's value, for example, if you're buying a house, you might get a lower interest rate than if you wanted to borrow for 90% of the home's value because that 90% loan is a higher risk. In the world of SBA loans, it doesn't matter if you borrow 50% or 90%, the interest rate is always the same. And so this is what I infer to as a subsidy to business acquisition, because the true change in riskiness of the loans, given the amount of leverage applied to an acquisition, is never reflected in the cost of the debt, which under a normal free market system it would be. And so that sort of low interest rate, even on a 90% loan to value loan, in my mind, represents a subsidy to the activity of business acquisition. And so this is why, you get so much of it and you get so many people excited about it. And so many people who get into business acquisition using this loan program will max out the leverage. And even lenders encourage people to do that, even though it leads to weaker companies, it leads to weaker balance sheets, which have a higher degree of leverage on them. Um, More identity verification up front. It's kind of blew me away. They actually want to know who you are. In fact, I saw in one of these websites where the SBA is now mandating that they collect your date of birth when you make a loan application, which I thought was incredible because I would have assumed that that was always required. I guess not. Guarantee fees. So because this loan program basically guarantees the loan to the bank if there's some kind of default, everyone has to pay a fee to participate in the program, which is essentially an insurance premium to insure the loans from the banker's point of view. And these were waived in large part during the COVID time, and so they're back. Updated credit scoring guidance, so they're going to require sort of a higher rating. And I'm not familiar with the SBA system. It's called SBSS, and they've got a different scoring methodology. So I guess this is kind of like how creditworthy you are, and maybe an examination of your assets and things like that. And it says here more changes coming on the first. This other website that I found, this is Commercial Lending X. They've also got a summary, and you can find there's literally dozens of these sort of summaries that are up there. Some other specific sort of changes. SBA small loan amounts, they've changed the amount, and it's more of an express loan application process. They've reduced that to 350,000. They talk about higher qualifications here. The SBA franchise directory. So once upon a time, the SBA kept a list of sort of approved franchise names. So if you wanted to get a loan to open a new franchise, they had to be on the list of approved names. That was eliminated a couple years ago. Now it's back. Um, the reinstatement of 10% minimum down payment for business startups. Uh, Again, wow, that's a lot of leverage for something that has no cash flow. Um, Certain management agreements now make businesses ineligible for SBA financing. It has to do with ways that people were using leverage to create opportunities, I guess, for people to take control of businesses versus actually buying them. Um, Passive real estate transactions, ability to sell marijuana, criminal record qualifications. You can see the changes here are quite detailed. And I'm not going to get into all of these. It talks about specifics here. This one blew me away, actually. Leasehold improvement requirement. So if you're borrowing a bunch of money and part of the collateral is leasehold improvements, which means you're going to open or buy a business in a rented location. And if you think about a fast food restaurant, for example, a certain decor package was put into that leased location. When you buy that business, part of what you're buying is the fact that those leasehold fit ups have already been done. And what they're saying here is that the term of the loan must match the lease. So if you're going to borrow over a 10-year period, the lease has to give you 10 years in that location to take advantage of those fit ups. I'm kind of blown away that this wasn't part of the requirements before, but it's being put in here as saying, yeah, you have to make sure the lease matches the loan term. If you only have 8 years left on the lease, for example, then maybe the bank loan should only be for 8 years. That's what they're saying here. Um, Ownership changes for business divisions. So they're also one of the rules that they've also changed is that if there's going to be a carve out, so if you're buying part of a business, then there's not going to be a tax return available for that particular part of the business. So they're saying that they'll look at things like CPA prepared statements examining only that division in order to um, make the loan decision. No merchant cash advance or factoring refinancing allowed. So basically, if you are a business owner who has gotten into trouble with merchant cash advances or with very expensive factoring and you're trying to refinance your business to take those loans out, they're no longer going to allow that, which I think, you know, hey, i- if you get into those kinds of credit facilities, not so much factoring, but merchant cash advance, if you get into merchant cash advance, it usually means that you're in some kind of trouble that you aren't bankable anyway. But in my mind, if you can demonstrate that you are a good, solid business and maybe you're not making money because of the high finance fees that you're paying from a merchant cash advance, it would make sense to refinance that to be able to get lower cost debt. And I certainly know many business owners who've done that over the years, mostly because they didn't understand just how expensive merchant cash advance was. And then they used an SBA loan to refinance themselves out of that. Now it's specifically forbidden. So it kind of closes the door to some people to get out of a very uh, predatory credit product into something that would be a lot more affordable for them. Partial ownership changes, we're going to get into that in a minute in more detail. Updated equity requirements, I'm going to get that into that in a little more detail here in a second. Changes to required equity under a partner buyout and changes to required equity under a partial change of ownership. Listen, if you get into the SBA rules, you're going to realize very quickly that you need to find a knowledgeable person that's going to help you through this process. And that either means finding like a banker who basically works on this stuff all the time versus sort of a general banker who might from time to time do an SBA loan. So you want to find someone who really knows the ins and outs of these products, or or some kind of broker who knows the ins and outs of these products who can really help you navigate this and see if your deal will qualify and if what you want to do makes sense or it would be allowed. There's life insurance updates and let's go to the next page because the next page is actually an email that Heather Enderson had put out. Now, Heather appeared on my YouTube channel a couple years ago where she talked about being an SBA loan broker. I'll put a link to her interview down in the show notes below. But she also has an email list, and her company name is Viso. And she put out this email, and I thought that I would go through it because she really works with a lot of searchers who are buying businesses. And so some of the things that she points out are very specific to this community. And so the personal resource test, this is an interesting one because the whole idea behind the SBA originally was that they were going to provide credit access to small business owners who could not normally access credit. And so one of the changes in the 2025 updates is that they're saying, hey, we've got a lot of really wealthy, high net worth individuals who are taking out SBA loans. Is that really who this program is for? And so what they're saying now is that part of these changes is going to be that if you are a wealthy person, the bank is going to have to more thoroughly demonstrate why you should have access to this program if you have other means, resources, and assets, including spousal assets, that could make your business acquisition deal work without needing an SBA loan. Now, it's interesting because with the higher interest rate versus, sort of, um, senior collateralized credit you might get from a bank in a conventional way, the SBA loan is a little bit more expensive. And with the fees, I will often run into high net worth individuals who will opt to not use the SBA program because they don't want to encumber assets through things like the requirement of putting a lien on their house, or they can use their assets to get money conventionally, and actually it's cheaper than if they were to use an SBA loan program. The sponsor of the channel is Mark Willis. He helps people set up these cash value life insurance programs, for example. And you can often, if you have such a life insurance program policy in place, you can borrow against the policy in order to do a loan for a business purpose for cheaper than an SBA loan might be, for example, right? And so what they're saying here is they're saying, hey, if we want people to actually prove that they need this program versus just simply giving it to everyone willy nilly, and I would argue that people that are in a wealthier position may not want to use the SBA anyway, because it's cheaper not to. Um, the full note, seller note on full standby as equity injection. So in the changes that happened back in 2023 that were clarified in 2024, um, they allowed seller notes to be on standby for 2 years, I think, and then you could start paying them. but they weren't taking those notes necessarily into account when looking at the cash flow of the deal, which in my mind was insane. Because what you're basically saying is that you're assuming that the new owner of the business will grow the business to the point where there will be additional free cash flow available to make the seller note payment in 2 years' time, even though they can't afford it today, right? What the update to the rule is saying is that it's saying if the seller is going to make a seller note. Now, they're talking about seller notes acting as equity. When does a seller note act as debt? Well, it acts as debt when it is debt. It acts as equity when it behaves like equity. And for a seller note to behave like equity, it means it needs to have no cash flow demand on the buyer. And so they've gone back to that where they've said if you want to have a seller note, like a 5% seller note, act as half of your down payment, and the new minimum down payment is 10%, then that seller note has to act like it really is equity, which means no interest, no payments of any kind until the SBA loan is paid off, which means the seller is going to have to agree to allow that 5% note to sit there for maybe 10 years before they get any money on it. Now, I don't know if you can have an interest accrual, for example, if you can say that the seller note will accrue interest over the period of 10 years. And so it will grow over that 10-year period to be a much higher note at the end. But they are saying that while the SBA is owed money, you cannot make payments on that seller note. To me, that makes perfect sense, right? Because what it means is that that seller's equity is truly being left behind to act like equity, and equity has no cash flow demand, right? So this makes a lot of sense to me. Rollover equity requirements, and sorry, those seller notes left behind to act as equity can only be 50% of the buyer's equity. Now, what does that mean? It means if you want a stronger equity position, if you say, "Hey, I want a 30% equity position and I only want to borrow 70," you could ask the seller for a standby note of 15 worth 15% of the deal. Are they gonna agree to that? Well, I don't know. You get what you negotiate, right? But the opportunity now exists to, basically angle it in a little bit of a third party way. Like, hey, for this deal to work, we can't have as much leverage. We need a greater equity position. One of the ways to do that is for you, Mr. Seller, to provide one of these standby notes, and that will allow us to do this deal, et cetera, et cetera. As sellers continue to want 2021 pricing, even though interest rates are higher and there's the threat of a looming recession, all that kind of stuff. Doing something like this with a higher standby note could be a way to allow that seller to walk away with the higher vanity price, so that aspirational amount of money that they're going to get, while still making the numbers work for you, because you get to basically defer the obligation on paying for that equity until after the SBA loan is paid in full. So, you know, as things change, there's always ways that perhaps there could be opportunities that come into it. Um, the rollover equity requirements. So, what they're saying now is that if you buy a business and you let the seller keep a certain portion of it, even if it's less than 20% ownership, the seller is going to have to guarantee the full loan for 2 years. And, it says here, and in much of the stuff that I'm reading, that a lot of these sellers are going to not wanna do that. Now, I would say that there's an exception to this. Um, Back last year, I released a video about the 2023 SBA loan changes, and I think you can see the title there, where I said 2023 SBA changes, are they evil? Right? And one of the things that I was worried about with the previous set of rules is that a business seller could basically set up an employee, potentially kind of like a pawn, to take on a huge amount of leverage and pay that money out to the seller. And then the seller could like stay on to give guidance or whatever. But by not being a guarantor on the loan, all the liability of that loan would fall on that employee who became the owner. And it's a particularly dangerous scenario because I have seen people taken advantage of in that way before. If someone wants to sell a business, they can't find anyone to buy it because of normal things, normal reasons why you wouldn't want to buy it. And so then what they do is they approach one of their employees and say, "Hey, you're a smart guy. How about I help you buy this business and I'll do all the things we need to get the loan. And basically, the owner of the business sets the person up to be like a fall guy, and then but they get all the money from the financing, right? And my suspicion is that they've seen this happen, and that's why they're going back to this kind of rule, where they're saying if you are going to be the seller and you're going to keep a partial stake, then you're going to be on the hook for this loan. Now, why do I think it isn't necessarily going to be a non-starter for most people is because there's a lot of really good, honest, helpful, caring people out there who own businesses who actually do want to help maybe one of their employees get into business. And I could see a two people with a trusting relationship, an owner and a manager, for example, where the seller wants to see that person succeed, wants to set them up for success, wants the legacy of the business to continue, and because of their continued willingness to be involved and help guide, coach, et cetera, that manager, I bet some of those business owners won't have a problem with this. They will agree, even though they are now a minority owner, to guarantee the full loan. Uh, because think about it this way, where did the loan proceeds go? It went to them. So if I'm the business seller and I received, you know, 90% of the money from my business, and I've got that money now, and I put it into some kind of investment that's pretty secure, and then I'm still on the hook for the entire loan. Over the next 2 years, I give coaching, guidance, and advice to the new owner. If they mess up in some way, I might end up having to take the business back, but I've got the money from the loan, right? The only people who would be afraid of this are people who literally want to take the money and run. And so, um, judging the sort of relationship you have with the seller, I think is really important in understanding, where their mindset is and where their heart is. And this tool just helped, particularly employee buyers in a big way, be able to better negotiate the right kind of support that they need from sellers. So this is definitely a buyer positive move in my mind. This requirement for sellers that retain less than 20% to guarantee the full loan. Stock deal requirement for partial buy-ins. Um, and so this is, talks about the structure of the deal. Heather doesn't think that this is going to be a good thing for deal making. Again, with buyers and sellers that know each other really well, it may not be such a problem. And then she talks as well about the CPA reviewed financials for things like carve outs, which I think makes good sense, right? Now, some other people out there, have very positive outlooks on these changes. So there's one here. Richard Parker is another person out there on the internet who helps people buy businesses and has been talking about buying businesses for a long time, like 20 years or something. And he put this interesting post out a week ago from the time I'm recording this, and he says, will the new SBA loan guidelines kill small business acquisitions? I know it's small on the screen. I try to make it larger. I'm going to go through the highlights here. And he says, I've read a lot of posts regarding the upcoming changes and that it's going to be really bad. So the people that think that this is going to be really bad are the people who have been encouraging, coaching, or teaching people to do extreme high leverage, very little down payment kind of deals, or bring in investors that are less than 20% investors, who are going to kind of sit on the sideline. And basically what he's talking about are people who call themselves self-funded searchers to a large degree. And so a lot of the self-funded searchers, what they do is they come in with a very small equity position. They don't have a lot of money. They'll find investors that will bring money in, and the investors will take a small equity position in the business, such that they don't have to guarantee the loan or put their name on the loan. And one of the changes to the SBA rules is that anyone who is an owner of the business has to appear on the loan as a borrower. And that, I think, has sent a little bit of a chilling effect through that self-funded search community, because now all of a sudden you're realizing, it's going to be harder perhaps to find these investors who are going to be willing to appear as a borrower on the loan, right? Again, remember how I said earlier that the SBA loan program kind of acts as a subsidy to small and medium-sized business acquisition? Well, there are some smart, wealthy people who have realized, hey, if I make a whole bunch of small 25, $50,000 loans to these searchers to help them with their equity position, but I don't take I'm not what they call a beneficial owner. So I don't have more than 20% ownership in the business. I don't have to appear on any of the guarantees or any of the loan documents. I basically get to make these high potential return investments while limiting my downside, and my investment returns are enhanced by this subsidy that is provided in a roundabout way by the federal government by guaranteeing these loans, right? And so those doors now have sort of, while they're not completely slammed shut, they've closed to a certain degree because now the whole proposition is less attractive to those investors. What Richard goes on to say is, unlike many others who have expressed utter shock at the changes, I'm not surprised at all. My only reaction is why it took so long for the SBA underwriting to bring common sense into the equation. My guess, probably what Richard is guessing by this statement, is that they've seen a bunch of nonsense deals come through. And they've seen a bunch of stuff where people were way over leveraged and they do the deal and then they end up exploding. I mean, we had Jed Morris here on the channel here a couple weeks ago on a live conversation. And just his story, how he did one deal and then he did another deal and another deal, like just the promotion of high leverage, extremely risky balance sheet expansion type of deals, is what Richard is referring to here. Um, he says, I was asked on a podcast yesterday if this will destroy the business for sale market. And he says, no, it won't. It's going to have the exact opposite effect. And I agree with Richard. He says it will cull the herd, meaning most, if not all, of the so called searchers with no money, no experience buying businesses who think they know what they're doing and with delusional aspirations about how to finance an acquisition will disappear. And it's about time. And the last couple of weeks, I've been making videos about this, right? About if you're broke and you have no money, you shouldn't be trying to buy a business. You should be trying to get a better job. You should be trying to start a side hustle. You should learn a little bit about business. Like buying businesses and business acquisition is for business people. And that doesn't mean that it's only for people that own a business. There's many business people who are managers in a business, salespeople in a business. They learn business by being in somebody else's business. Um, if you're a business person, you know it. And you're a business person not because you decide to be, you're a business person because you've lived through things and had experiences and you've seen things go up and down. And you've seen how, surprisingly, the really unlikely things that ruin a deal seem to happen all the time, right? That's when you become a business person. Um, he goes on to say, hopefully, it will also eliminate the clowns, con artists, and thieves selling BS misinformation and multi-thousand-dollar programs that mislead people to believing they can acquire good companies with no money down by absentee run businesses that, in fact, typically fail fast or negotiate deal terms that simply do not materialize in the real world. Yeah, I hope so too. I really do. Um, Richard says, I've stood on the sidelines and watched this nonsense unfold with prospective business buyers who've never bought a business yet think they know how to do it, and self anointed gurus teaching people how to do something that most have never done themselves. Or the jokers who have purchased one or two companies and suddenly think they're an expert. Yeah, I would agree. If you don't know, if you haven't been watching my channel for a long time, uh, back in 2008 is when I started working in the field of being a broker to help people buy and sell companies. And since that time, I've evolved into a consultant. And here, my team and I, we look at sometimes two or three, sometimes even four new files every week of people doing deals. So we know what's happening. We know what's possible because we're seeing the deals all the time. And the people in my group coaching program are doing deals all the time. And I'm sitting in on all those meetings and we're seeing what people are doing, what they can really negotiate, what is really possible, et cetera. And, deals happen every day when buyers have cash. Cash is an important component of doing deal making. And there's a lot of people out there hyping things up, trying to encourage people who have no money that they can somehow get into this. And it's the age old get rich quick, something for nothing kind of con, which is, basically that you can somehow get something of real value, a good cash flowing, profitable business, even though you have nothing to trade for it. And people want to believe that because people get into a state of desperation or, frustration or whatever with their lives. Um, you need to have some money if you're going to buy a business. Let's continue with Richard. He goes, I saw one guy this week pitching online who bought two companies, both of which failed, and is now trying to teach people how to buy businesses based on the so called lessons that he learned. And he goes, the fallout is predictable. It may not happen immediately, but the SBA loan pullback is the first step. It's time to get back to buying businesses the old fashioned way with knowledge, expert guidance, realistic deal terms, no BS, and yes, putting money down. And, this post got 11 comments and 30 likes because, of course, realistic content on the internet doesn't get a lot of likes and shares, right? So, so what do I think? I'll tell you, over the last couple of years, since I've been running the group coaching program in particular, and it's really a great insight into what is happening in the market because the people in the group are sort of sharing everything along their journey, and they're sharing information about the conversations they're having with sellers and with brokers, and they're also talking to bankers, and they're also going through the experience of making offers maybe on a business where more than one buyer is trying to make an offer, and they'll make really great offers and get outbid by people who are offering more money. And a lot of the times, we have these conversations in the group where it's like, how on earth can somebody else afford to pay more for this? It just doesn't make sense. And the reality is that those offers are being made by people, not usually people that are stronger financially with more resources that are like strategic acquirers. More often than not, those higher offers are being made by people who don't see all the problems that we're talking about in the group. And so it's like you see these deals happening and you're like, I know that that person who's doing that deal is setting themselves up for a spectacular implosion at some point. But what can you do? Like, you can't uh well, reach out and warn that person. I mean, they think that they're doing a smart deal. There's all kinds of people that I will meet, unfortunately, after they've done one of these deals, where they've ended up in a lot of trouble. And the reason they've ended up in a lot of trouble is because they end up in these over leveraged situations with these super weak balance sheets, and because they've got so much debt going into it, they don't have the ability to borrow anymore inside the business if there's like an opportunity or a need to replace something, or they could grow in some way naturally. They end up stuck. And because they've maxed out the price that they can offer by maxing out the leverage, if something goes wrong in the business, then they basically starve. The first thing they have to cut is their own paycheck. I was recently in Ohio at the Economy Conference, which is a fire community conference. And I shared actually in the feed of my YouTube channel a link over to there. And I gave a talk about, the dangers of over leveraging in business acquisition. And that's what the SBA program is the doorway to. It's the pathway to. It's a pathway to extreme leverage. I would argue, even with the new changes that have come in, which make it more difficult for people to borrow to the maximum, um, the the program itself still allows a super high degree of leverage. Like 90% debt on something as risky as a small business, it is doesn't make sense to me. Back when I was first learning business brokerage, I remember I went to Atlanta and at the IBBA conference in 2010, and there was a talk being given, and they were talking about the SBA loan program. And back in those days, I believe that the maximum loan to value that the SBA would do is about 65 or 70%, which in my mind kind of lined up with commercial real estate leverage. And I thought that was a little bit too much because I'm like, businesses are far riskier than buildings. Why would they guarantee loans as risky as commercial property loans on something like a business? But, they were doing it. And what has happened since then is there's been ever increasing degrees of leverage offered by the SBA program. And what is the net result? The net result is that the prices of small businesses have continued to climb, and the multiples people have been willing to pay have continued to climb. And There was a comment put out by another creator, Michael Girdley, who was talking about why the SBA program was such a great program. And one of the comments he said is that every Canadian I talk to says they wishes they had it. And I'm Canadian, and I can say that it's a two-edged sword. Because what I will point out to Canadian business buyers is that if there was something like an SBA program available in Canada, which offered 90% leverage on the full value of the business, including goodwill, that what it would do is it would lead to higher prices. In any market, anywhere you go, the people who most often are the ones that are trying to create financing vehicles are not people trying to acquire things. It's people trying to sell things. Think of a car dealership. When you go to a car dealership, the average price of a car now is like 50 grand or something. And most car dealers know that people just don't have $50,000 in a bank account. And so they've got all the different financing options lined up for you there. And in fact, some of the earliest financing opportunities for cars came from the car makers themselves. GM set up a finance arm, Ford set up a finance arm, et cetera, because providing financing for something makes it easier for people to buy it, right? And so this is why I've always been on record as saying the SBA does not help people buy businesses. The SBA helps people sell them, right? And if you're out there and you're a business buyer, keep that in mind. Just because you have access to credit doesn't necessarily mean that it makes sense to use it. And I've coached many people in the United States and people in my group coaching program that even though they could get 90% financing, that isn't always the thing that makes sense. You want to have a material amount of seller financing in every deal because seller financing can be negotiated such that it's subject to offset in the case of material misrepresentations or undeclared or undisclosed liens or liabilities. And if there's already a 90% loan, that last 10%, we just learned from the SBA rule changes that the seller note is limited to half of that. 5% does not leave enough room for offsets against much of anything, right? You want a much more materially sized vendor take back or seller note financing so that you can have offset clauses. It's always wise to have a strong equity position on your balance sheet. um, so just because you can get this money from a bank doesn't mean you should. And I can tell you that there are bankers out there who will encourage you to do it because bankers are incentivized to make the biggest possible loans and lend out the most money they can. That's how the banks earn money, through making loans. There are lots of people in the group coaching program that I've helped over the years who have successfully used SBA financing, but they've limited it. And they've also gotten the advantages of seller financing notes. And they've even put in greater equity amounts when it made sense for them to do that too. So, with that, I would say if you are interested in learning more about that, head over to businessbuyeradvantage.com. You can learn about my online training. It's in the step number 2 section. Step number 3 section talks about the group coaching program, which really, if you want help as you go through this journey, that's the place to be. And you've got access to all of our meetings going back to 2018, so you can really learn through the experience that other people have had. And with that, I'll say good luck, and I'll see you all next time. Cheers.
So, how can you learn more about buying, selling, financing, and managing small and medium sized businesses? Easy. Go over to my blog site, davidcbarnett.com, where you can learn more about me and how I work with my clients. You can learn more about my books and courses that I've prepared for you. You can find out how to subscribe to my email list, the YouTube playlists, and more. There's literally hundreds of hours of content there, all for free, and I'd love for you to be my guest. Special thanks go to Mark Willis at Lake Growth Financial, today's video sponsor. Mark helps people better manage their personal and business finances through the Bank on Yourself insurance strategy. This is something I've done personally and I've seen others use it successfully for years. Go to newbankingsolution.com to find all the interviews I've done with Mark and learn more about the advantages of these programs. While there, sign up for a free consultation to learn what this solution might look like for you.